This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to discuss the market trade and what we saw on the day Wednesday, we welcome in our good friend Mike Zuzolo of Global Commodity Analytics joining us here on Market Talk today. Mike, great to catch up with you, sir. How are you?
Great to be back with you, Jesse. I'm doing great. We're still a little dry here in this part of northeastern Kansas, but we cannot complain given what the poor people and ranchers and farmers south and west of us are contending with at this point. So we're still hanging in there with, I think, above average crop yields at this stage. But a couple weeks from now, if we don't have any rain, I might have to lower that down some.
Well, that's something we're going to keep our eye on. I know we'll talk more about that coming up. I want to start, though, soybeans. What happened on Wednesday in the soybean trade, Mike? We were seeing great strength, and then we kind of just faded. What happened?
I think that the big thing to realize about the soybeans is that they've had about a $3 run from low to high up until today's high. And I think that the trade understands that a lot of the reason why they're rallying and why they've been able to diverge from corn and wheat until the last maybe 24 or 36 hours when the weather and the dollar has come into play in a favorable way for the wheat and the corn. But the reason the beans have been able to move so aggressive with the meal has been the fact that we've got this currency relationship developing where the Brazilian currency in 2 weeks of time has eroded about 8 weeks of losses. In other words, this is the second week of a stronger week for the Brazilian real against the US dollar, and it's at an 8-week high as of today. This is a weekly chart of the US dollar versus the Brazilian real. Remember, in these kind of charts, when you have the US dollar on top, when the chart is showing higher prices, that means the dollar's gaining on the real. So the fact this market is in a third lower week and eating into the 8 prior weeks of price action says and shows you the real is strengthening. And notice where that tick is at about 5.08 reals to the US dollar. That's about a percentage point off the highs. And so I think a big element to the soybean rally, Jesse, and why we've gained this $3 in price so quickly has been this chart right here. And I'm sure there's some other fundamentals out there too, but I think the funds and the ability of the currency funds really has to be considered. If you're not familiar with it, I think it's a good time to get in touch with somebody like me that really follows this, because this is just as important as the yield that comes out by USDA on Friday when it comes to the price trend for soybeans.
Well, I want to flip charts on the video screen and stay on the soybean track, talk the world soybean price. What are you seeing with this chart, Mike? And talk to me a little bit more about your thoughts heading into Friday with this soybean market, especially after the way the trade acted on Wednesday.
So the neatest thing about this chart is the prior chart. Remember what I just said, that we've just had a $3 rally in U.S. soybeans. So the purple line on this is our Gulf of Mexico bean price. Even with a $3 rally roughly in soybeans and lead month futures, the cash price for beans in the United States is still at about $20, $25 cheaper than the Brazilian Paranagua export price. That's your currency showing up right there, Jesse. You're at a 631 Gulf of Mexico price against a $656 per ton price in Brazil. And I think this is why we saw China come in and buy some soybeans from the United States on Wednesday morning. And this is really the heart and soul of why the funds care about the currency so much and care about the Brazilian currency so much, because let's face it, when it comes to China especially, they're trying to buy as much South American product and as little U.S. product as possible, but they aren't going to continue to do that if the U.S. dollar keeps sinking to the Brazilian currency. So this is where the rubber hits the road as far as, well, you talk about currencies, what's it really mean to me in the production side of things and in U.S. exports? And that's what it really means is $3 rally in U.S. futures still keeps you $25 a ton cheaper than the Brazilian price. As far as the report goes, I think there's two big things to watch. The first thing is, going back to the June 30th data, USDA NASS has said that they may reintegrate new acreage data into this August 12th report because we still had 4 million acres of corn and over 15, almost 16 million acres of beans unplanted as of the time of the acreage survey. I talked to the head of NASS last week, Lance Honig, and I asked him, where do we stand with this? And he essentially said to me, if we get the numbers from FSA and they're certified, they will go into the August 12th report. So we could look forward to potentially a big increase in U.S. soybean acreage base. I was at 90 million acres back in the springtime. I still think 90 million acres is still fairly correct and accurate, and that's the number I'm going to keep on the numbers on the spreadsheet for me until I see Friday's numbers. The second thing to watch is the spread. Notice the old crop, new crop spread. Which price is right? Is it the August price that's getting ready to go off the board, or is it the September and November price, which is correct? Sometimes when we go into an August report with this type of a premium in the old crop, it's just a sheer show of how tight our old crop supplies are. I want to see if the 2021 ending stocks are clipped very dramatically or not. And that's going to factor into a lot of whether I pull a lot of hedge triggers for 22 crop and 23 crop or not.
That's a great point you make with the soybean, with the old crop and new crop spread, et cetera. Looking at the corn market, Mike, let's shift gears over there. Corn held up rather firmly on Wednesday, despite the pullback in beans late. You look at corn, though, we look at the weather issues, of course, the Western Plains, and we look at a good crop in the East on corn. What's your thoughts heading into Friday's report in this corn market? And just, it feels like we've maybe had a little bit of sideways action, price action here the last couple of weeks.
Yeah, it's been held back by the wheat. There's just no way around that. And part of that is the currency. Part of that is the Ukrainian situation and trying to figure out how many ships are going to get on the water each week. But I think, Jesse, we're coming back to a more of a July report feel when it comes to corn, where we could see the corn diverge from the rest of the group because we are in the mix of a very dramatic, hot, dry period that I think after traveling from Atchison to Detroit on Thursday and back from Detroit, Michigan to Atchison on Sunday, we are losing a vast majority of the central corn belt crop right here, right now. I was shocked by the amount of corn that still had yellow tassels, bright yellow tassels, and no silks that were brown. I would say around a third of it. And so I'm really concerned about tip back again this year, like I was last year after this road trip. In fact, this picture you're showing is one of two corn pictures around that where the drought monitor shows up the most in the crop. And this area along US 231 that I snapped this picture was south of Lafayette, Indiana, and it was on some gravelly ground. It was not the best ground in Tippecanoe County, Indiana, but it's good ground, it's flat ground, and you can see how it's been stressed and how it's getting clipped at this point. And right after I sent this picture to clients, I had a client near Linden, Indiana, which is just about 20 miles. He's actually probably around 10 miles from this field that I drove by because I used to live in Lafayette. And he said to me on an email, he said, we are definitely going to have tip back and we're definitely going to have smaller ears this year. We are down in this part of the country. And that part of the country really does supply us with a large percentage of the state corn yield. This is another example in Indiana, not maybe a little farther away from Lafayette, farther north of town in Lafayette. And you see the whiteness of the tassels. You see that the silks really aren't browning up at all. As I said, 30% of the corn crop on my travels were like that. And the dramatic change from the way this crop looked on Thursday when I drove up to Detroit versus Sunday when I came back was really amazing because it had been 92 degrees all 3 days that I had not traveled. And it was 90 degrees until I got to Chillicothe, Missouri at 10 o'clock Sunday night. And I think this heat stress is really taking over and clipping our yields in the corn especially. So states that should be supporting the national corn yield, I think they're going backwards at this point. And that's why Des Moines, Iowa, Mankato, Minnesota, they're going to be big players. But I think we've kind of forgotten what's happening back east, as you kind of alluded to. And I thought the same thing until I took this trip.
Now, Mike, as well, one thought that I have just real quick, obviously the USDA report on Friday, they're going to be looking at conditions as of August 1st. Mm-hmm. Now, we've seen a lot of deterioration since August 1st. I know it's August 10th, but I wonder how much that could factor into thinking is, what will we see on the report, last week or so? How big of a difference will that make maybe getting into the September report, Mike?
No, I think that's a really great point because remember last year in the August report, USDA took the corn yield from 179.5 down to 174.6 and really surprised the trade because that was a 2.7% cut. I was at 175 at that point, and so it wasn't a surprise to me, except that they did it so early. I thought they'd do it probably more in September, but that was when Iowa and Minnesota were suffering so much, Jesse, and I think that's the big question mark as you go into Friday's report. I'm with you 100%. I don't know what the USDA is going to say on Friday because of the crop progress report this week showing that they should drop it back some. But by the same token, they've dropped it once already this year. So why not wait a little bit? Could be the logic. And just for kicks, the August report, which usually never sees a bean yield reduction, they usually really wait until September, in my mindset anyway. We had a 1.6% drop in yield last year in the August report for the soybeans and went right down to 50 bushels. And so it's possible that they will cut yield, but I think you're right. It may be just a little bit too early. So the key, I think, to take away from the report before we jump to livestock is the idea the report may mean very little if we're still looking at hot and dry conditions in Des Moines, Iowa and Mankato, Minnesota for the next 7 to 10 days. Because I think we're really hurting this crop right now. And it's almost like it's a July report, not an August report when it comes to yield potential.
Well, Mike, let's segue to livestock here and talk about that. A pretty solid day on the day, Wednesday in cattle and hogs on the futures trade. I think cattle looked a little bit stronger than hogs. Let's start with the cattle side. Not a whole lot of cash activity yet this week, but as you look at this cattle market, what are your thoughts there right now?
The negotiated market is starting to pick up a little bit here at midweek, and that's usually indicative of a late cash trade, in my opinion. And I think the live price is probably close to that 139, 140 level across the 5 area, or Kansas, Nebraska, especially Kansas. I think the big thing with cattle right now, Jesse, other than the gap in the August contract that's at 140.27, and that's an area that I'll probably put some hedges in place if we can fill that. I think the biggest thing is we continue to see the female slaughter rates really high. And until we stop seeing that, we're not going to see the weights go down. The dressed weights are going to stay high because of those females. But once we do see that, I think we've ended our liquidation phase. And then we can start counting the days, I think, for when we're going to really tighten up on market-ready supplies. And so I could see this market being very sloppy, driven very hard by the grains, market-ready cattle, ample supplies, calf guys have been calling me this week wondering, do I retain? Do I put a lot more down? What's it going to be like in the feeder cattle market here with this liquidation because of the feed price and because of the hay price? And so I think it's a sloppy market for the rest of August, especially with us losing that summer grilling seasonal.
How about hogs? August contract getting ready to go off the board. I don't know if October, that contract can make up its mind. Does it want to go up to August? Does it want to hold pat around $100? That's kind of where we're at right now. As you look at the hog market, what's your take there?
We've gotten new news out of China in terms of CPI data, and their pork numbers looked better as far as CPI. So I'll be watching to see if our export sales on Thursday morning support us with big Chinese purchases. If that's the case, that helps the October market as the August goes off the board, I think. But if you ask me in a week from now, I think that I'll be saying that we've peaked in the belly seasonal, that the October hogs don't need to go up to where the August is, $20+ difference there, and that the October can get a little bit more premium to them, but I would not be surprised to see the August go off the board weaker and come closer with the cash index coming together with both of them kind of leaning lower at this point. So I think I'm seeing a high in the belly seasonal at this point. If that's the case, that's what really drove and put the afterburners on the August hog chart.
Well, you mentioned hogs and cattle, and we think about demand at the consumer level, and you mentioned the CPI. I got to give us time to talk about that today as well. Consumer Price Index coming out Wednesday showing a bit of a moderation in those inflation numbers. What are your thoughts after looking at the CPI, how that plays into all of our commodities as a whole, Mike?
Yeah, excellent question. I'm really glad you asked it because it's really super important, I think, to the funds and the investors, the inflation data did not show much of a jump in July until you drilled down. And when you look at food at home prices on the CPI number, Jesse, that was up over 13% versus July of 2021. So on an annualized basis, we are paying 13% more. We all know that's probably less or it's probably a lower number than what we're really paying at the grocery store. But it shows the funds and the investors that this inflation on the food side is not backing down. And I think that actually maybe will attract some money into the food commodities, the agriculture sector especially, as long as we keep pressure on the US dollar. And I think that's where the CPI data, the big top line number really helped us, because it really took away the idea the Fed has to be as aggressive as what we were thinking. And that's why the stock market and the grains had such a good day, was they think, okay, the pressure's off now. The Fed's not going to keep tightening the screw on the money supply and push us into a recession, which essentially equates to deflation, not inflation. So I think it was about the best CPI report we could have gotten, and the dollar reaction was about the best dollar reaction we could have gotten. I want to see if we can't keep that weaker dollar trend going all the way through to Friday's close, and keep the D's corn above 625, which was the old monthly high until today, and keep the Nove beans above 1481, which is its current monthly high. Those two numbers are real important to me once we close out this week.
And a weaker dollar, of course, I think could help the wheat market. We didn't touch a lot on wheat today, but a solid day in all three complexes there. And I think a lot of that probably attributed to the weaker U.S. dollar.
And without a doubt, and I think the European market is still very much the point man when it comes to the wheat, because drought in Europe is getting worse and worse. I mean, it's record. Some parts of Spain are having 1,000-year drought right now. And so if the Ukrainians don't ship out a lot, we could get a lot more business on a weaker dollar. Yeah.
Mike, I know I want to talk to energies a little bit, looking at propane, natural gas. We're still watching those markets. We're watching crude oil. One more chart on the video for us here. Walk us through what you're seeing, talking propane.
Well, last week I made the text blast out to all the clients and subscribers to move on to getting their fall needs locked in for every energy out there, mainly because of what's going on in Russia and what's going on with the natural gas spigot being tapped and turned off. That's happening now this week in Ukraine. I think the propane price going back down to $1.17 a gallon, getting back to last fall's lows, that's probably the best we can get at this point, given what's going on over in Europe. Even though stocks are increasing at this point in a pretty nice clip since March, April, I think that this is probably going to start to peak a little bit early as far as stocks going up. I think we'll start to see the stocks being pulled down because we'll have a lot more demand on the export front. So I would take a look at that. This is one of those things where get in touch with me individually if you have questions, because I know that energy prices are a very regional issue, and some may not be getting this kind of a price level.
Fantastic. Mike, before we run out of time, floor is yours. The open-ended question, as always. Any other final thoughts you have for us today?
Well, the dollar's been doing us a good job on the analysis the last 6 or 7 months. I think it will continue to, because that's where the funds and the money is really at, trading $6.5–7 trillion a day in that commodity or in that complex in the currency. So go to globalcomresearch.com, pick up a free trial. I think it'll be worth your while, especially during this weather time period and this supply time period. I just finished up my corn national yield number. I'll be sending that to clients and subscribers tonight.
Mike, always a pleasure, sir. Great to catch up with you, and we will talk to you again next week. Thanks for the time.
Thank you, Jesse. Great to be back with you, sir.
Mike Zuzolo, Global Commodity Analytics, joining us today here on Market Talk. That's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.